Hello friends, today we're taking a look at General Mills, ticker symbol GIS. They are recovering from their 52-week low of $60.33. They are up 1.2% in the last month. Year to date, they're down almost 22%, and they're almost 29% down from their May 2023 highs. In the last 5 years, they are up about 70%, but their price is pretty close to the March 2022 lows. So they're going to be reporting this week on December 22nd, and some analysts believe that there is a upside of about 15% in the next 12 months. So the question is General Mills a good company for us to take a look and add to our portfolio? Welcome to my channel. I'm Martin, and we try to talk about our finances, take control of our finances, find great companies at great prices. If you have not subscribed, I encourage you to subscribe, and please leave a comment letting me know what you think about my analysis, your bull cases, your bear cases, and most importantly, how silly my new tagline is. Continuing to what we're going to be doing today is we're going to be looking at some of the analysts' um, revisions or what analysts are expecting. We're going to talk a little bit why the stock has come down so much. We're going to talk about who General Mills is. We're going to be looking at the last 10-year financials. We'll look at a couple of valuations, trying to come up with a fair value, and then we'll just try to find a margin. We'll add a margin of safety. So we'll start with who is General Mills. General Mills is a company that makes cereal. They make a lot of different snacks that you may be familiar with. They own Betty Crocker, Annie, Biscuit, Cheerios, and Cocoa Puff, Cinnamon Crunch, Fiber One. Um, this ice cream, Henson Das. I don't know how to pronounce it, but it's delicious. Also, they have Old Tower, I believe, Lucky Charms, which I love it. El Paso, um, Fieldbury. They also have and many other products like Joe Plate. They also have a line for dog food. I think it's called Blue something. But anyway, so they produce a lot of different food products. In the last earnings on September 20th, they beat on EPS, but just by a little bit. And revenue, there was a beat, but compared with the actual revenue of almost $5 billion, beating revenue by 3.7%, 3.7 million, it was very, very small. And that's one of the reasons why they are down. In the upcoming earnings report, which is going to be on December 20th, they're looking for the EPS to be higher, the revenue to definitely be higher at 5.36 billions. There in the last 90 days, they have received 3 upgrades and 12 downgrades. So it's not looking good for the short-term future of General Mills. One of the things that as I was reading news and I was looking at why are they down, it seems like their interest rates have been going up, the interest expenses. Also, they have been having more expenses. They're paying more in taxes, so their net income has been going down, and which leads me to let's take a look at the last 10 years of fundamentals. As you can see, the revenue is kind of flat. In the last 10 years, it only has grown 1.5%. It has picked up in the last 5 years at 4.2%. This is not necessarily a bad thing. Um, I do like to see companies that their revenue are growing at 15%. But when these companies like General Mills, Coca-Cola, when they have grown a lot, it is really hard for them to continue to grow. And most of investors will like to see is actually reduction on expenses and um, improvement in the earnings. When it comes to earnings, as you can see, it looks a little better in the last 10 years. They have been growing at 3.7%, while in the last 5 years, they have had a really nice jump at 7%. Their 5 year average of the profit margin is almost 13%, which is not bad. Free cash flow, it seems to be a little flat. In the last 10 years, it has grown 1.2%, but in the last 5 years is down almost 2%. Their average free cash flow margin in the last 5 years is 13.5%. Not good. I like to see a lot of these growth rates, the revenue, the earnings, the free cash flow, and the book value. For me to consider this an amazing, wonderful company, they have to be like in 15% growth. In the last 10 years, their book value has grown at 5.1%, while in the last 5 years, they have grown at 8.3%. And I don't know if you're noticing the theme that it seems like in the last 5 years they have picked up growing. The return on equity is in the average in the last 5 years is 26.5%, which is great. I like to see this number above 15%. Revenue, I mean the return to assets in the last 5 years is at 7.3, which is great. I normally look at 5%. Their 5 year return on invested capital is a little lower than the 15% that I normally look at, 11%, but it's not bad. So their dividend has been growing, and it was flat for a while, kind of flat from my perspective. Well, actually, literally flat between 2018 and 2020. But it has been picking up. I think the latest increase was almost 8%. But if we look at a bigger picture at 10 years, it has grown at 3.6%, and in the last 5 years at 2.4%. Their payout ratio right now is a little above the 50% that I like at 57%, but it's not something that it will concern me. When it comes to debt, debt has been going up and down. In the last 5 years, have grown at 5%, and in the last 10 years, have grown 5%. In the last 5 years, down 1.5%. But they can pay off all their long-term debt in less than 5 years with their 5 year free cash flow numbers, which is great. When it comes to the outstanding shares, as you can see, it looks like a roller coaster. I don't like this. And honestly, I haven't had the time to look more at why their outstanding shares grew. Sometimes this happens whenever there's acquisitions. Instead of just getting into debt or paying cash, companies tend to issue shares in order to buy another company out. So that would be something that if you were to invest in this company, I will encourage you to do your own due diligence and see what happened between 2019. So in 2019, 2020 and 21, it could have been that they just issue a little extra just because of the COVID issues. A lot of companies did that during that time. As you can see, the the outstanding shares are kind of flat in the past 10 years to 5 years. At least with the numbers, it has been going down a little bit. Anyway, this is too much talk about shares. Let's move to the financials. If we look at the 5-year finances, the analysts believe that in the next 5 years, they're going to be growing at about 7.5% a year in average. Revenue is 4, earnings 7, free cash flow dropping at almost 2%, book value at 8. So I'm probably going to be using at 5% when it comes to my valuations. And as we jump into valuations, I want to remind you that I am just a YouTuber. I am not your financial advisor. I encourage you not to make any decisions based on my to buy or sell based on my opinions or any other YouTuber. So that's my disclaimer. When we look at the historical multiple valuation, this is a valuation that I like because it tells me what the market is willing to pay based on their last 5 years. Whenever we look at the multiples in the last 10 years, what the um, the market has been willing to pay based on revenue, earnings, free cash flow, book value, or their dividends. It's somewhere between $70 to $72, and I like when these valuations are pretty close because it kind of gives me a little more extra confident. So that is what it will be fair value today based on what the market has been willing to pay in the past. And this is a big thing that we always need to remember, that just because the company was great 10 years ago or 5 years ago, that doesn't mean that it's still great right now. But it does give us a little bit of an idea of how they're doing. When it comes to payback time, this is now projecting if we were to hold the stock for the next 15 years, growing at 5%, uh, whether you're using the trailing 12 months free cash flow per share or the average in the last 5 years, that will give you a fair value somewhere between $82 to $98. If we were to look at the discounted earning valuation, growing at a 5%, using an average PE of 18, we're looking at a fair value somewhere between $44 to $47. If we use Buffett's owner's earning valuation, we're looking somewhere between 71 to $86 a share. When we put everything together, we see that the fair value is somewhere between $70 to $71, which is a 8% from current prices. If I wanted to maybe if I were to jump into this company, I will probably be looking to maybe a 15 to maybe 30% margin of safety. This margin of safety of 30 that has not been there. $50 that hasn't been there since the 2020s, March of 2020. So um, so that will be something for you to think about. If you prefer a 15%, you're looking at prices close to the 52-week lows. I personally think that this is a company that, if you like diversification, this would be a good company to maybe have. They have good um, numbers when it comes to their return to equity and return to asset. I personally think that since right now I am more into wanting to grow my portfolio, I will probably be passing on this company. But anyway, that's what I have for today. I hope that you enjoy it. Leave a comment, a like, and a subscribe. If you would like to get a copy of this um, sheet that I have, I will be putting the link down in the description. Hope to see you in the next video.